Mastering Throughput Accounting. Throughput Accounting's ruthless quest for maximum profitability demands harsh ROI scrutiny. How is the investment in a resource or process calculated, taking into account the organization's goal of maximizing throughput, and what specific metrics or formulas are used to determine the return on investment in the context of throughput accounting? In throughput accounting, the investment in a resource or process is calculated with the goal of maximizing throughput, which is the rate at which the system generates money through sales. This approach is based on the theory of constraints, TOC, which identifies the bottleneck or constraint in a system that limits its ability to generate throughput. To calculate the investment in a resource or process, throughput accounting uses three key metrics. 1. Throughput, T, the rate at which the system generates money through sales. It is calculated by multiplying the selling price of a unit by the number of units sold. 2. Investment, I, the total amount of money invested in a resource, process, or project. This includes the initial investment and any ongoing expenditures. 3. Operating expense, OI, the total amount of money spent to operate the resource, process, or project. This includes labor, materials, and other expenses. The return on investment, ROI, in throughput accounting is calculated using the following formula. Return on investment, ROI, equals delta T, delta I, where delta T is the change in throughput and delta I is the change in investment. To evaluate the investment in a resource or process, throughput accounting uses the following steps. 1. Identify the constraint. Identify the bottleneck or constraint in the system that limits its ability to generate throughput. This is typically done using the 5 focusing steps: identify the constraint, decide how to exploit the constraint, subordinate everything else to the constraint, elevate the constraint, and go back to the first step. 2. Calculate the throughput per unit of constraint. Calculate the throughput per unit of the constraint. This is done by dividing the total throughput by the number of units of the constraint. 3. Calculate the investment per unit of constraint. Calculate the investment per unit of the constraint. This is done by dividing the total investment by the number of units of the constraint. 4. Calculate the ROI. Calculate the ROI using the formula above. 5. Evaluate the investment. Evaluate the investment based on the ROI. If the ROI is positive, the investment is considered viable. If the ROI is negative, the investment is not viable. For example, suppose a company is considering investing in a new machine that will increase production capacity. The company currently sells 100 units per day at 00 per unit, resulting in a daily throughput of 0,000. The new machine will cost 0,000 and is expected to increase production capacity by 20%. The operating expense for the new machine is estimated to be 000 per month. To evaluate the investment, the company would follow these steps. 1. Identify the constraint. The constraint is the production capacity of the machine. 2. Calculate the throughput per unit of constraint. The current throughput is 0,000 per day. With the new machine, the throughput is expected to increase by 20%, resulting in a new throughput of 2,000 per day. 3. Calculate the investment per unit of constraint. The investment per unit of constraint is 0,000. 20% equals 50,000 per unit of production capacity. 4. Calculate the ROI. The ROI is calculated as delta T, delta I equals 2,000 to 0,000, 50,000 equals 4%. 5. Evaluate the investment. The ROI is positive, indicating that the investment is viable. In this example, the company would consider investing in the new machine because the ROI is positive, indicating that the investment will result in an increase in throughput.